Okay, folks, welcome back. Price action model number 7, universal trading model. And this teaching is going to specifically deal with sell side low resistance liquidity runs and fractals. All right, price action model number 7. Again, this is universal trading, so it's applicable to every style of trading. That means position trading, swing trading, short-term trading, day trading, and scalping. This model again is focusing on the sell side low resistance liquidity runs utilizing the fractal. And our stage for this model is a liquidity draw. In other words, we're looking for a higher time frame level to absorb liquidity. Okay, the setup is sell side market maker profile. Now, because we have two market maker profiles, we have a buy model and we have a sell model. Both have a sell side delivery. In other words, the portion of the model or profile that goes lower, seeking liquidity. That's what we're going to be focusing on for our setups for this model. And the pattern itself is going to be referring to fair value as a simple go-to. Okay, so the sell side expansion on a market maker sell model, when the chart, and again this is any time frame, presents us with a bearish condition for a market, we have to understand when the market is poised to move lower based on a draw on liquidity. As you see here on this crude depiction, the market will seek a level of liquidity. Once it reaches that, it will have a tendency to move lower if the higher time frame indicates that it's feasible. In other words, if it's likely to occur, this is how we're going to start stalking our setups. Now, between the moment and price, when we identify the liquidity the market will seek and the price level of the targeted liquidity, in other words, after this initial run up, we're expecting the market to go lower. So we need to target a level of liquidity below the market. Once we determine that what that price level is, this is our targeted liquidity, and between those two price points is our range of opportunity. So we have equal lows here. So we know there's a sell side liquidity pool resting below that, and that would be our targeted liquidity. The range of opportunity is shown here, and there is 1, 2 areas of key points of liquidity, because everything is germane with the original buy side of the curve of our market maker sell model here. Initially, we have the run up, the retracement back into the original consolidation. So this is a return back to fair value. We have an expansion move up, trade back down. Again, we don't look for classic support and resistance theory here. We're waiting for it to retrace back. Once the market gives us another buying opportunity in here, it rallies up to an area of higher time frame liquidity. Once it reaches this liquidity, and we are essentially bearish, if you will, we would expect to see price trade lower. Once we see the market break down below our highest reaccumulation of longs, okay, and it's going to be this one here. Go back and watch model number 6, and it'll refer to these specific price points. Where we get this low here, we draw that out through the curve, which is the midpoint of the overall fractal. Draw that out in time. The market will look to seek to trade back to that level, and then there will be a measure of distribution. Okay, in other words, sell side imbalances will start creating the movement lower, large ranges down. Many times it doesn't need to go back up to this level here. So for your notes, just know that on the lower time frames, like for instance a 1 hour or a 15-minute time frame, they don't necessarily have to come back to this one. But if it doesn't, that's fine, because the second opportunity will create a larger, more protracted expansion on the downside. In other words, there's going to be a larger degree of a price swing unfold than just reaching below the liquidity here. Okay, and go back and listen to that portion again. Lots of nuggets in that segment of commentary. So we're looking for opportunities to sell short here and sell short here, initially targeting here. Now, if we get a run significantly below this low here and it runs below the initial 0.1 of reaccumulation of longs on a sell model. On this market maker sell profile, if again the market breaks down right to this one, okay, and again looking at the overall structure, every fractal, every price swing is going to be slightly different, but the general theme and rule of thumb is the algorithm will seek this price point here, or if it runs through this one, in other words, if we get this price leg here all the way down and it blows right through this one, then once it retraces back up inside of the down closed candles in this swing low, okay, once that occurs, we're going to expect a large dynamic move farther than just this liquidity pool here on sell stops. Okay, so let's move on. Okay, we're looking at a weekly liquidity distribution profile, and this is going to look similar to what we showed in the price action model number 6. Over here we have the last, if you will, on the reaccumulation of longs on the sell side. Over here we match up where the buy side was offered. In other words, every time we created a bullish scenario to the left of the curve, that's this vertical line here, with the liquidity distribution profile, what we're doing is, and what I'm actually trying to communicate to you is, the way the algorithm will seek to pair up previous levels of buy side and sell side delivery. Over here, during the buy side of a market maker sell model, once it creates that smart money reversal, and notice I'm teaching the higher level, in other words, in terms of probability, because this level here takes some experience. Okay, I don't want you thinking that you're going to be able to nail the high and then go short here and go short here and then go to the bank, just being all happy with no resistance, if you will. I want you to focus on the opportunities that reside with once the second of the buy side reaccumulation on a market maker sell profile, once that's broken on the right side of the curve here, what we're going to be doing is we're going to be looking for the market to create a pairing of orders in the form of a fair value gap, or where there was old sell stops over here below that swing low that would have created a new reaccumulation in there. Those sell stops, they will get ran out there. We want to see that take place. Once those sell stops are ran out, then a return back up into this level of liquidity in the form of the down closed candles, that's where we're looking for to pair our orders for going short, because there's going to be a form of mitigation there. So in other words, they're going to knock out the longs that were rallying up here and trying to make profit. They're stopped out. Then the market will return back to fair value. The fair value is going to be determined by the down closed candles that make up the swing low to the left of the curve of this overall expected price swing. So in other words, the theory is we're expecting price to go up to eventually go down. So we're watching price accumulate, and something over here we may have been able to go long on based on what we learned in price action model number 6. But even if we did not, this is the importance that I want you to understand. The power in this insight is that you don't have to be a buyer when the market trades up to this level here. Your whole profile and your model may be looking for this structure to form, and once it breaks down and trades below the second of the reaccumulation of the buy side of the curve on a sell side model, okay, and obviously this is going to take you a couple times to listen to, but go back and look at price action model number 6 and refer to the notes that's been provided in the mentorship. If we take out the second level of reaccumulation on the buy side of the curve of a sell model, once that occurs, we have a high probability to see it seek the first initial reaccumulation of longs. In other words, it doesn't show it here, but I'm showing it in this form because I want you to know that this, from a theory standpoint, this would represent the higher of the two. In other words, we have a consolidation, it runs up, comes back down, finds the retracing back to the original consolidation. That would be 0.1 of reaccumulation of longs. then it rallies up, then retraces back down. This is the second buying opportunity or reaccumulation of longs, then rallying up to some level of buy-side liquidity to offset the longs that you were seeing be accumulated here. They're selling them here. Now, you're not going to know without a great deal of experience where this is going to be the reversal. And that's why I'm not teaching that, because you have to look at things like I'm showing you here, and then over time and experience, that will teach you when to anticipate that smart money reversal. Okay, so there will be times that you can go in and fish, drop a small little position in here. If you think that the likelihood of that formation of a intermediate term or long-term high is forming, you can put a really small position on there. And then hopefully once it gets down here and creates the scenario that we're outlining here, the higher of the two swing lows prior to the reversal here, when that breaks, that's our market structure break. We're not going to look at this small little short-term market structure break that creates the low risk entry. Okay, the low risk entry requires high experience. Okay, you need to have a lot of experience to get to that. But again, I'm not trying to hold it back and say, well, you don't deserve it yet. You do get it by experience, but you get it by experience by doing what I'm showing you here. So we're looking at the higher of the two reaccumulation, and in some models there may be actually three accumulations. There may be one returns back to the consolidation, two reaccumulation, and it never reaches that buy side liquidity pool yet, and then a third one creates that. In that case, again, we're always using the higher between the original consolidation and where we thought that market would reach for liquidity. Whichever the higher of the reaccumulation of longs is seen, whatever that swing low is, we want to see that be broken. Once the market seeks the liquidity below that, runs the sell stops below that on the left side of the curve. Once that occurs, and believe me, I'll show you examples of this in price, but nonetheless, once the sell stops are taken, then we wait for fair value to be traded back to. In other words, it could run the stops, then come back up into the bodies of the down closed candles of the swing low that's formed here. Again, underline this in your notes, if the highest reaccumulation of longs on the buy side of the curve of a sell model, in other words, price is accumulated sideways, it moves higher, trades up, and then goes down. What we're looking for is that break in market structure of the highest of the reaccumulation of longs prior to a point of liquidity being taken out above an old high or some measure of a premium array. And again, go back and look at the market maker models and overlap with that content from month number 5 where we talk about the PD array matrix. So we have that model of breaking market structure relative to a specific price point. It's not just, well, it's going to be a break of market structure if it takes this low down or takes this high down. No, it's a very specific structure that's being shown here. And that's what this liquidity distribution profile provides you. This slide is something that will not be shown by anyone else. Okay, the content that's being shown to you here is unique to me. Because of the institutional delivery of liquidity, that aspect of retail learning and trading is void. It doesn't exist. Okay, so when we have folks that are suggesting that they have a order flow background or something to that effect, or even supply and demand, this is the missing link. They don't have this. Okay, so when we have an understanding of liquidity distribution, once we have that element in our trading, we don't need charts. We don't need candlesticks. We don't need any of that. We just need to have an old reference point in terms of price. So traders that used this information off floor, in other words, if they were a floor trader before, they would use the excitement and fever of buying and selling around a specific level. And they would get a feel for where the order book would be as a whole by watching the activity in the pits. Now, when they left the pits, when everything went to electronic trading, there was this major adjustment, and a lot of them never really could get it. They couldn't adjust for it. I learned tape reading while I was a commodity trader, and I would just watch CNBC and Back then it was FNN. It was just the same type of event where you would watch a ticker tape, and you would just see this scrolling every 10 minutes. The futures market would update, and it would tell you where the price is. Now, it doesn't give you the high and the low, but I would study that literally during the New York session for the S&P and the bond market. And I would try to get a read on what it was doing by making a notation. And I'm not saying that you should be doing this. I'm just giving you the evolution, if you will, of how I internalized how price has been delivered. Because I've always felt that it was to some degree controlled and manipulated, but I never understood how it could be, because we're always told in books the market's too big to be manipulated, and that's not entirely true. So once we have this liquidity distribution model understood, we know specifically the protocol for when is a market structure break. Okay, there's so many people that have their charts, lipstick and all marked up like I teach in my free tutorials. And they'll have the jargon and the terminology, on their either commentary, or if they're tweeting something, or if they're in the YouTube making videos, and they'll say, "Here's a market structure break," and if it doesn't fit this criteria, then it's not a break in market structure. Okay, it's not there. So there's going to be times when we have a market maker sell profile. Okay, and just so you know, I'm getting a vibe right now. Someone's listening, and they're thinking, okay, when you say market maker sell model or sell profile, what is that? Like, how do I know that? All you're looking for is a bounce in an existing bearish market. That means you're bouncing over here off of something, and you don't have to know when it was going to bounce. In other words, I'm not suggesting that I know it's going to create an accumulation here and go up, retrade back to the accumulation, and find support and buy there, go higher and create one or two more successive buying opportunities to create this turning point. I may not see this opportunity until the highest of the reaccumulation alongside has been broken. Then it might jump off the chart at me. Okay, because it may be a pair, it may be a stock, it may be an indice, it may be something that someone asked me in an email or send a tweet about, and then immediately my mind goes into contrarian mode, and I break it down like this. So I'm looking for the distribution profile from a liquidity standpoint. Where is the orders, and why is the narrative more likely to fail them? And I'm going to capitalize on that in my own trading. So when we see things like on like Baby Pips or Forex Factory or something to that effect, where we have these very highly opinionated folks, and they want to share their charts and they show their annotations on the chart, I love that. I love it, simply because it gives me a greater read on retail. And if we combine what I'm showing you here and teaching by the liquidity distribution profile, once we know this and we study the market from that perspective, it's a game changer. There's nothing there's nothing else to be worrying about. We just wait. So it removes all the ambiguity about which supply and which demand zone. Okay, it removes all the ambiguity of what resistance and support line you should have, because these things don't exist. There is a specific price point. Okay, specific price point, and we did this with an institutional price model that was taught in mentorship. And quite honestly, I don't recall what month it is in, but I'm not asking anybody to tweet that either, because all it's going to do is just ask or force traders that are in mentorship to ask questions. This is all chart member level, so just keep it that way. But the liquidity distribution profile that's shown here, it looks just like a simple little, the depiction of a graph or chart, okay, or a drawing, if you will. And this is how I internalized it. This is the bridge of when I looked at Wyckoff. Okay, Wyckoff, I get accused of, oh, you're teaching Wyckoff. Let me tell you something. Wyckoff never got this close. When you look at Wyckoff, there, he talks about the markup and the markdown phase, okay, and cycle. That's great. And initially, when I first looked at it, it looked like nonsense, and it didn't make any sense to me. Why? Because it didn't have chart patterns. It didn't have a candlestick chart over top. It didn't have an open, high, low, and closed bar on it. It didn't have moving averages on it. It didn't have any indicators on it. It just talked about the market going up and then market going down. And to me, it sounded like, well, obviously, that's hindsight. I mean, anybody could talk about it like that. and which is what everyone else thinks they see when they start looking at my content. Even folks that go through the free tutorials, okay, and some of you that went through the initial few months, it felt like, well, this is this regurgitated Wyckoff stuff, and it's not. And that's why I encourage everyone to go through, study it. I studied it at great lengths and depths, and while I already understood some measure of it because of experience, I quickly built upon the basic premise because it helped me formulate a model for, okay, when the market is bullish short term, but intermediate term it's bearish, that's what this liquidity distribution profile is showing. Okay, because the market's here and I anticipate it going lower, but first it may rally. Okay, so if we have that condition, this is how we use it. So maybe we've been in a long-term or intermediate-term bear market for a particular market or pair, and we hit some level that is questionable. It creates a likelihood of a bounce. Okay, great. If it's going to bounce, we do our PD array matrix, see where the premium and discount levels are and where the equilibrium is, and we find some measure of premium in here. Now, once we have a level of premium, in other words, how high it can go, then we start specifically breaking down the PD arrays from a premium standpoint. And then we map those out for buy-side liquidity. In other words, something above current price over here, okay, prior to the expected run up to create a selling opportunity. Remember, this model is universal. So it's going to take you several times to watch this and Model 6 as well. And you probably will find it more beneficial next year. Okay, and the reason why I'm saying that is you'll see more things having learned it from a theory and conceptual standpoint, and you'll see it applied like I'm going to show you with the dollar Swiss. Okay, so everything that's being shown here is very, very deep, but it's dry. It's very, very dry content. But you will understand the market from a greater depth and appreciation for the way liquidity is delivered, neutralized, and or engineered when you understand this whole premise here. This is there's about 5 or 6 more things that I won't talk about, not even until we probably get to 2020. But this is one specific thing. Once you understand this, it unlocks when is the market really showing a market structure break and when is it just running stops. You have to know what this is showing you, okay, from the narrative side. In other words, what is price doing? Why is price doing what it's doing? Okay, if once you have that, it removes the whole confusion and it's just simply a matter of waiting. And that's what you're looking for in your trading. You want to know, okay, I'm not going to do anything right now because there's nothing to do. But how long should I wait? And when do I know the wait is over and then I can capitalize on the current condition? That's what this liquidity distribution profile does. It provides a framework where I don't need a chart. I don't trade charts. I trade distribution of liquidity. Because the bank is the storefront. They're the storehouse, if you will. They provide the currency or they provide the asset. They are the underwriter for stocks. They are the provider of the liquidity. So I just completely skipped over the whole what's the chart telling me, where's the trend lines and what's the indicators telling me, to what is likely going on behind the scenes. Because if I can determine the narrative behind price, the behaviors are going to be pretty generic going forward. And I know with a great deal of certainty, not complete understanding and perfection, but I have a great deal of certainty that I know the probable behavior going forward in that market. Now, if I cannot get a read on price with this element, this is the first of a few things that I do. But if I can't see it from this perspective or outline a model that would, give me the framework, if you will, of what price should be doing relative to this, then I don't touch the market, or I sit on my hands and say, okay, we're just waiting for more insights. So underline that. Okay, this is the video that you want to come back to next year, because there's a lot of things that will click into place once you watch this video a couple times, and every 2 weeks come back to this one, and then you will see more price data. We'll see more examples of what I've shown, and then also go back and watch in December. We're not going to be doing a whole lot, and half of January. Go back and watch the previous weekly videos where I'm talking about, okay, I'm looking for specific things, or I don't have an idea right now what's going on, and then compare that with what I'm showing you here, and it'll make perfect sense. You'll know what I didn't talk about then because it wasn't for you to learn then. Now you have it. So we have our liquidity distribution profile. This is what we do in terms of viewing price action. It's not the open, high, low, and close. That's a tool that we use to work within this narrative. But we have to watch the highest of the last reaccumulation of longs once the liquidity has been taken here. In other words, it may have been, for instance, this is a weekly chart perspective. The market may be rallying off of some bullish order block in here, and we expect it to bounce, but we don't really expect the downtrend to end. But we run up above a short-term high to run the buy stops. Okay, well, once those are absorbed, the question is how do I know if it's going to continue going on or if it's going to break down? And then if that breakdown is a market structure shift, or is it just a run on the sell stops over here? Think about what I just told you. The higher time frame narrative is what we're looking for, because the institutional order flow on that level is more apt to continue versus something we would see, for instance, on a 5 or 15 or even 60-minute basis, because those trends or those price runs that we see on those lower time frames are very sporadic and very short-term in nature. So the large funds are not out there trying to do, $50 million on a transaction that is going to pan out over a 15-minute chart that would take up a couple hours of the day. That's not their model. You can only move so many millions of dollars, okay, inside of a short fluctuation in price. So their expectation on price is from a higher time frame macro standpoint, monthly, weekly, daily. And they don't really look at anything less than the daily because everything is framed from that daily chart up. And that's why like COT reflects all those price behaviors and they align. And that's why we spend so much time on the daily chart, because without this narrative, you're not going to be consistent and you're not going to find longevity. So once we have this understood, go back and watch the video again, and there's a couple points I've given you in this video that frame out a lot of reoccurring questions that come up in the forum, reoccurring questions that come to me by email, and or things that I see when people think they understand, they're still making that same mistake of not knowing what really makes a market structure break, or a shift in market structure, if you will. So moving on. We have the daily chart. Also, once we see our weekly chart, we're anticipating the same thing to form on the daily chart, but the only thing is now our range of opportunity shifts from the daily to a 4-hour and 60-minute time frame. And we'll be able to break the market down more or less like a top-down approach. But what we're doing is we're refining the fractal. And I'll show you what that is and what it means when we go into the dollar Swiss chart and examples towards the end of the video. But here we're focusing on, from a daily perspective, we're expecting this run up to find some distribution and selling. Okay, that we're expecting the large fund institutional order flow to shift in here and start going lower. When that highest of the long, or the highest of the reaccumulation of longs, put it that way, the reaccumulation over here, whichever the highest one is, swing low to the left of the curve, once that's broken, but we have to see the liquidity run first. Once it's taken, there's no more real storyline, if you will, to go higher. So once we see that on a weekly chart, on a daily, we're expecting that same thing to occur, but now we're refining that fractal and we're saying, okay, over here, we're going to look at a 4-hour or a 60-minute time frame, and we're going to break that down into really tight precision. So we'll expect, again, the sell stops to be ran over here on the left side of the curve, and then it returns back to fair value. Fair value is going to be the down close candles or down close candle on the 4-hour or 60-minute time frame. Once it trades into that candle, we will be looking for sell signals. Okay, something to go short. Now, from a daily standpoint, this would be in the form of we expect the price to run down below the low on a 4-hour or 60-minute basis, and then we have our power 3. We can now incorporate day trading and short-term trading using the scalping and day trading concepts you learn in mentorship. So what does that mean? Say it occurs, we run down below the sell stops over here on, say, a Thursday or Friday. We wait the weekend. We don't care what Sunday's doing. And then on Monday, if we rally back up into the bodies of the down close candle or candles over here, which is the highest of the reaccumulation of longs before the buy side liquidity is run out. In other words, to make it in layman's terms, if we think that there is a level of buy side liquidity that's going to be a draw on liquidity, when price gets to that price point, once it's done that, it's over. We're going to wait for evidences that the market's going to go lower. What is that? That break below the highest of the reaccumulation of longs that occurred prior to that higher time frame premium array that we were aiming for to be ran out, or in the simplest of terms, a resistance price point. Okay, now some level of resistance. Now, retail isn't going to see it that way because they're going to be looking for some old low or an old high where it's going to stop dead in its tracks and turn around. We've learned that that's not always the case. You have external range liquidity and internal range liquidity. So this whole return back up here could be a return to a weekly bearish order block, or it could be trading up into a weekly fair value gap or close a liquidity void. Whatever the PD array matrix is allowing you to identify during and prior to this whole run-up, that's what you use. Everything is going to be slightly different. Remember, there may not be a fair value gap. There may not be a liquidity void, but there will be a bearish order block. And if there was already a stop run to the left over here somewhere, if it comes back up to the bearish order block, we know that that's more likely to hold versus running a new higher high for higher level buy stops. Okay, so just go back and look at month number 5 content. It'll help you kind of like dovetail with what I'm teaching you here. So once that highest level of reaccumulation of longs on the left side of the curve is taken out, we do have a qualified shift in market structure. Again, if it trades all the way down to the second one, okay, of the two that would be over here, or the first of reaccumulation of longs prior to the run up to the smart money reversal, then we know that there's going to be a larger degree of distribution. There'll be a larger magnet on liquidity that would take price just not below here, but a longer term price swing. Okay, and the reason why that occurs, and this is the theory behind it, if we go below the first of the reaccumulation of longs here, and it keeps on going, that's not just a simple run on sell stops, that's a heavy measure of distribution. And say we go down below the first reaccumulation of longs over here. In other words, accumulation sideways, it breaks out of the consolidation, comes back down. There's your reaccumulation of longs, which is not shown in the chart here, because I want you to learn the highest of whatever swing lows that form here. You want to go to the highest one. Once that's broken on the right side of the curve, once that's occurring over here, then you're anticipating these events. Okay, so you're looking for the sell stop run, then return to fair value. Once that occurs, then you're looking for it to sell off again. And it creates an opportunity that if we get this scenario and you miss this one, find the next buy side over here. In other words, where the swing low is prior to a run up, it's going to match over here. That's what's missing from Wyckoff. Okay, Wyckoff, very generic theme, okay, and everyone talks about it the same way, but you never see anyone using Wyckoff with this level of precision and understanding, because Wyckoff doesn't know things from an algorithmic standpoint. It was too far back in history. Because of my computer science and information systems training, when I was learning to be a computer programmer and be a systems analyst, that never happened because I never found a job using it. that whole experience, and I thank God for putting me in that direction, because even though it didn't pan out that way, it gave me a great deal of insights about how things work from a technological standpoint. In other words, we create these things like in Lotus 123, if you guys know what that is, like an old spreadsheet program, kind of like Excel. We would create these things called macros, and they're like little programs. You do this, do that, do this. If it does this, you do that. Okay, and I thought long and hard about if the markets were going to be controlled, they would have to have some kind of logic behind it, and then everything had to be there. Everything had to be as it needs to be for it to run efficiently and work correctly. Syntax has to be correct. There has to be opportunity or data to pull from. Okay, and that's why we have the PD arrays, because we come back to those same price points just like the algorithm will. Okay, so it takes me a great deal of time and effort to take folks that have never learned computer programming or thought of things like an algorithmic perspective. It takes a lot more time for folks that have never been exposed to it to learn this. Folks that are highly technical can readily assimilate to what I'm showing and teaching because they've already been exposed to that from higher level maths and or some measure of computer programming. Now today, in high schools, they offer computer programming, and I think it's a wonderful procedure to force, if you will, onto students, because it gives them a framework to look at how everything is algorithmic now, from advertising to efficient staffing of companies. Everything is algorithmic, and if you don't understand that, there are many books out there that talk about algorithms and things, and some of them will probably be very boring for you. Others will probably be more insightful and user-friendly. But I don't have any of them in my library, but I did read them in my schooling. And for the life of me, I can't remember any titles, so I already know I've opened up Pandora's box. Okay, what are those books, ICT? I just don't know. It's been such a long time, since 28, 29 years ago. It was back in school before I even considered being a trader. So just know that these levels of understanding are going to take a little bit more work and a lot more to chew on. But trust me, I didn't learn it the first time I was exposed to it, and the first time I made notations in my journals, it didn't click after a one-time experience. So just watching this video and models number 6 isn't going to click for you. So if you're feeling like you're still, like I can talk about it and you understand what I'm saying, that's good. That's all you're supposed to know right now. Okay, that's all you're supposed to know. Because when we go to our dollar Swiss chart and you start seeing a little bit more of it, it'll start becoming more obtainable and reachable. And over time, looking at previous examples of where I say I'm waiting for more information, this is what I'm waiting for. Okay? All right, so in this shaded area over here, our range of opportunity is from 0.1 to 0.2. But if 0.1 becomes, in essence, really 0.2, because it just completely blows through the first and goes below the second of the reaccumulation of the longs over here on the left side of the curve, if that occurs, we have the likelihood of a return back to fair value or optimal trade entry, and it's going to occur on a 4-hour or 60-minute chart relative to a daily price swing. So this whole price swing here is to be viewed and understood conceptually on a daily chart, but we refine that daily chart to these points of liquidity. Okay, so we have the liquidity distribution profile understood that inside this daily price swing, we know specifically what we're waiting for and what we're looking for. That is the highest of the reaccumulation, because if that breaks down after we've had a run on buy side liquidity, that's all that's going to be necessary. Because then if we see a distribution cycle unfold from 0.1 and we trade down to where 0.2 would be, we have no real reason to force we have to get in here or back here. Okay, a lot of folks see that I share trades, I share analysis, and I say, okay, well, we're probably going to go up here and in reverse. They assume I'm always selling the tops and I'm always buying the bottoms. I'm not. because I'm doing so many things, especially nowadays, I don't know, if I'm going to be in front of charts at the time because I'm so inundated with correspondence and people coming into mentorship, and folks that are just basically asking questions like, hey, look, I can't get my account open up. All that takes time. We have thousands of people that we have to manage. So it takes a lot out of me. So I just basically keep myself focused on the low-hanging fruit. And everyone else in the mentorship, especially the new people that came in, they're like, this is unbelievable. But it's just basically teaching from practical application what I'm showing you here. Over time, the graduated experience will provide you the context that gives you this turning point up here where you can be a buyer down here, reaccumulate here in heavy distribution, and then wait for the low resistance liquidity run that occurs at the smart money reversal or the low risk short. Once that occurs, you can't get any higher than that with my learning, because that's it. And I'm not saying that there isn't future lessons to get to that, but we have to get into 2020 before that's even scratched on the surface. But this here is the framework that you're looking for waiting for more insights, or if you hear me say I'm waiting or I'm sitting on my hands, this is exactly what I'm waiting for. Okay, and now you know the storyline behind it. And again, this is just one more level, but we go way farther than this, because we'll have aspects of time and much more precision in terms of what the market will do on a day-by-day basis and a weekly basis. Okay, so there's a lot more refinement that we got in terms of lessons ahead. And again, we won't even get into those until like 2020. All right, so moving on over. So we have sell-side expansion on a market maker buy model. So when the market is trading in consolidation, we expect it to trade down, find some measure of sell-side liquidity. In other words, it's going to reach for the market liquidity below an old low. It may trade back down to an old high, or it may trade down into a fair value gap or trade to a bullish order block. Right here is our draw on liquidity in the framework of this model. But we're inside this fractal, and our specific model number 7 is only focusing on traders that can see just the sell side, because I didn't understand short selling when I first started trading. I understood being a buyer, because obviously if you buy something cheap and you sell it for more money later on, you get the difference in the price, and that's great. And I didn't understand short selling, because how can you sell something you don't own and buy something back and you make the difference in price? So just like that, or similar to that, some of you may not see when to be a good buyer. Okay, or when there's buying opportunities, but you can see when there's short selling. That's a normal occurrence, and vice versa. Maybe you can't see what's being shown here in model number 7, but you can see clearly what's been shown in price action model number 6. All of you are going to have a unique perspective on price, and it's going to be internalized differently. I did not come to this conclusion and understanding all at one wave. Okay, it didn't come to me and I was like, I woke up and then boom, God laid all this on me in one day. We're talking about, 26 years now. So it was a gradual understanding. So give yourself the flexibility and permission to learn this. You're not going to get it in one video watch. Okay, it's not going to happen like that. So people that come in here and get to Charter Member and they're watching this, and you're just like you're watching it now, first class Charter Member, you're looking at this thinking, okay, this is a lot of dry theory, but this is the thing that you're looking for, but you don't know, because you're looking for something to occur in a chart, and it's not in the chart, it's the narrative. What makes the narrative from an institutional standpoint? Why should we be focusing on the liquidity that I talk about in our weekly analysis? Why should we focus there? And that's what these profiles focus on. The market maker buy model and the market maker sell model are just simple generic templates. And in the hands of a neophyte, it just looks like Wyckoff. And the reason why it looks like Wyckoff is because that's the way price swings occur. They start from a low point, it rallies up to a high, and then sells off. Either fails to go to the initial low, or it blows through it and then starts to go higher after a stop run, or it continues to go even much lower, which is a continuation. Those narratives are going to be determined from large sample sizes over years of trading. So it's important to just pick one of these out of the 12, price action models we're providing you. It's not essential that you learn all of them because you're not going to do very well trying to apply everything. But each time we talk about a new one, especially 6 and 7, it's going to provide you more understanding about the market as a whole, and then you will eventually gravitate to one, and that will be your foundation. Just like, well, I had one specific model, which was being a buyer, and I wanted to see a type 2 trend following with a bullish divergence in stochastics, and that was my model. And over time, I gradually moved into not needing a type 2. I didn't need a type 1 divergence. I didn't need a stochastic. I could see price wanting to go higher, and I knew exactly where I wanted to be a buyer. Now, again, that didn't manifest initially after I watched a couple of things, that I seen in my own study. If this was something that's going to happen really quick for you, I would tell you, if it ain't happening for you by this time, there's something wrong. I'm telling you to relax and allow this. This is all part of the process. And that's why most people cannot do this, because it requires a great deal of learning, experiencing, and seeing it not work a lot, learning from that, and a few times that it does work, it feels good, but we're focused on when it doesn't work, because where it doesn't work, that's where our light bulb moment comes in. And that's how I got to this information. So spending a lot of time in charts, trying to figure out what the narrative was behind it, and then only after it occurred, then I could see, oh yeah, that's what was going on. See, nobody cares about that. As you're learning and as you're a trader, no one, and that's why most people don't want to be in the mentorship, because they don't care about all these things. They just want to show me a chart, tell me when to buy and sell, and that's all I need. And that's not what they need. You're going to lose your money. So the folks that are hearing my voice right now in 2018, you're a charter member, and you've already tried probably trading with live funds. And I told you not to do that when you first joined. And you thought you figured it out because you watched a new video or something new came up, or a new concept or a tweak on something you thought you understood from a free tutorial, and you now have experienced more pain. So I tried to spare you that, so that way you wouldn't feel toxic and have these poor thinking while still learning. You're in the mentorship still. Until you know for certain what your model is, and you've done 6 months of consistent positive response to using that model on paper, then 6 months in a demo. So that means you're a year out. Even if you finish the first core content, who cares? You guys are in a hurry to get money, and it doesn't work like that. But if you are in a hurry to be patient, that's going to serve you better. So we have a liquidity draw below the marketplace, and we expect it to reach down to this level here. Now, we don't know if it's going to bounce here and create this, but the likelihood is if we have a consolidation here, we are in a long-term bullish or intermediate-term bull market, and we've kind of like petered out a little bit, and we've shown signs that we're wanting to go lower. Well, how far it's going to go? We look at a discount array using the PD array matrix. This may be a bullish order block. It may be a fair value gap. It may be an old high it trades back down to, or it may be just below an old low that's not being shown in this diagram that may be a run-on sell stops. Whatever those things are, because every chart's going to be different relative to the opportunities that's being made available at the time when you're looking at it. Because there's so many possible scenarios, I have templates that give you a rough idea on how to engage them, but you're still going to be limited to what do you see in your chart right now. That's why I do these examples on Twitter. What do you see? WDYS. They are to train your reticular activator system. In other words, what you see in price action over a long period of time, a sample size, and engaging in, you will learn. But you can't take 26 years and pour it into a couple videos or even 500 videos and expect to just watch it one time and then your ICT. It doesn't work like that. But once we have this draw on liquidity, we don't care about the right side of the curve, all this buy side over here. That's not what we're looking for. We're only looking for opportunities to frame shorting opportunities. Okay, so we can see, well, let's say it like this. I'm speaking with the perspective in mind that the trader that's listening to me that can see these scenarios, they're comfortable with looking to be a seller here and reaching down here. They don't necessarily know this is going to occur, and you don't need to. Okay? And that's the benefit of these specific models. Because once you understand it, you just wait for your setups. And that's what it means to know what you're looking for and wait for it. So between the price points and price where we notice it and identify the liquidity that the market will seek, that is down here, okay, and the targeted liquidity over here, this may be a draw later on. And that's why we limit it to wanting to take our short cover here, not looking for a longer term, because the likelihood is that we may come down here and create a market maker buy profile and then rally up. So if we have the market maker buy model occur here and it rallies up, if we've taken our profits here, this can't hurt us on any short positions. But then again, we don't know for certain that this is going to create that buying opportunity. And that's how we trade in the gray area. We do not trade with specific, this is the way it's going to be panaceas. Okay, be-all end-alls don't exist. We have framework, we have structure, we have things that we look for, and if they materialize, then we engage. But if they don't materialize, we wait for more information. And if they completely unravel, then it's over. So in this case, what would be those scenarios? If we are looking for an area in here where this is our range of opportunity, and you have 0.1, and then we have 0.2 down here, these are our two selling opportunities. Okay, look to go short. If we expect it to go short, and say we sell short here and we get stopped out and it continues to run and goes back above these equal highs, that means that we don't see a market maker buy model here at all, because it shouldn't do that until it creates a longer term run down here, creates the curve, then starts building on the side of the buy side. Once you determine on what you're going to focusing on your beginning or your foundational price action model, whichever you feel comfortable with. And I had an email from one of our chart members. He states that up until now the price action models have been useless to him, and he just looks for X, Y, Z, and there it is. And that's fine. That's a normal thing. I wasn't offended by that, and he's not the only one that sent that to me. The models that we talk about are just there for foundational purposes, because some people, they have all this content now, but what am I supposed to do with it? You don't need to have everything at your disposal, but over time you're going to learn when you can apply certain things and when you're going to feel comfortable using them in your model. You don't have to have every facet of the mentorship, and that's the whole point of these models, because none of them are exactly the same. But all of them will get you to a price point understanding where you can carve out setups every single week and sometimes daily, which is exactly what I'm showing you here. Price action model number 6 and number 7 are universal. So if you understand this information, as we show on Dollar Swiss in a little bit, you'll see that it's absolutely 100% what you don't know, but it's always been there. Even through the core content, using the information and then showing you beforehand, and then now I can go back and say, this is exactly what we've talked about in theory from a modular standpoint. Now it's been applied, and this is how you use it, and then put it into a price action model so you can start practicing with it and looking for opportunities and knowing that these are your models or your model, and you don't deviate from it, because you're not going to learn anything by, well, I'm going to do a little bit of price action model number 2, and I like model number 1. I'll do number 7 today, or I'll do it for this month. Don't do that. Whatever one you feel strongly about, or makes you feel like, oh, that makes sense, that's the one you go to, and you start there. All of you are going to have different levels of understanding. Some of you are much more advanced in my content. Some of you are still on the ropes about what you're supposed to do. There's not a lot of you like that, but there are some. And in fairness and in disclosure, we've been now a full year after the mentorship core content. And I have a couple of you that just feel like you're waffling, don't know really what you're doing. And that's okay. Don't let it beat you down. But you have to know that that's normal for some. And don't feel like you're, less intelligent or that you're never going to get this. It just means that you got to take a little bit more time, and your price action model suggestion may not have been shown yet. This is only 7. I got 5 more to go. So with that said, this is our range of opportunity. So we're going to be looking for our liquidity distribution profile to give us more insights. So we have that here. So we're expecting price to go down. That's all we need to know. Do we know that it's going to reach the sell side liquidity pool down here at a discount, some PD array, and bounce? No, we don't need to know that. Okay, so there's some of you that feel like you got to know 5 trades in advance. You don't need to do that. All you need to know is what's the opportunity right now. If there is none, you wait. Okay, it's simple as that. You don't start adding 15 different markets or asset classes or pairs to your arsenal just so you can find something. You pick 1 or 2 markets or a pair, and you focus there, and you wait for your specific setups. That's how you refine yourself as a trader. An analyst is improved when they're only being exposed to 1 or 2 things. It's going to be easy for someone to have an opinion about 30 different markets all at one time, and some of them are going to be right, some of them aren't. And what's going to happen is you or anyone else watching you, or that you made your opinions public, they're going to start doing ratios on how your percentage of accuracy on this and that, and assume right away that you're either not as good as you say you are or thought you were, and they're going to tell you all about it. And what's that going to do? It's going to be demoralizing for you. So your opinions and things that you expect are meant to go in your study journal, not on social media, because it's not going to be received like you want it to. I'm ICT, and there's many times I put things on the internet, they become, the gospel later on, months down the road, years later on. I mean, look at Bitcoin, for instance. I was getting laughed off the internet by crypto Twitter. And who's laughing now? So the point is you're never going to be received well doing that, because there's going to be a contrarian opinion. And many times I've already admitted that I'm always contrarian to whoever, even if it's a mentorship student. If they start putting a chart up there, immediately I'm going in there with a contrarian perspective. It doesn't mean I'm going in there and taking a trade immediately on the basis of being contrary. It just means that that's my nature. If you tell me don't walk on the grass, I'm tap dancing on it. Okay? It's just the way it is. That's me. So if we understand that the market's going lower, that's all that's necessary. We don't need to know that it's going to bounce here. That's not necessary for you to know that. I don't always know that. No one has that ability. No one has that. You might have it once in a while where you have a rhythm where you can get a good feel for it. And I think you've seen me do that this past year once or twice. But there's a couple times where you saw me wait for more information. And I'm waiting for, and sometimes I waited and it moved without me. And that's fine. That's not hurting anyone. It's not going to hurt you. It's not going to make you any less of a trader or analyst. None of that stuff's going to be detrimental to your longevity. It's going to increase it. It's going to build it up. So from a theory standpoint, we're looking for the market to trade lower. That's all that's necessary. Now, if we are bearish, it's just basically what we're doing here. We're essentially adopting the bear mindset. How are we going to go short? So we're looking for levels of redistribution. So in other words, we're looking for a level of accumulation of shorts. It's consolidated. Maybe it's consolidated and ran up and run some stops, or maybe it's just broke down because of relative strength analysis, suggesting that it shouldn't go higher. So therefore, a Judas swing on a higher time frame shouldn't be expected because of a correlated pair. Maybe it's already done that, and say, for instance, this is the cable, and the euro dollar maybe went higher on this time frame, ran stops and went lower, but because of sympathy, okay, the cable is going to move lower and not post that higher high, running an old high out and running stops, because then we'll have correlated SMT distribution shown from an SMT standpoint. Euro dollar making a higher high, cable not making a higher high. Okay, so whatever that is that forms the basis of your accumulation of short positions, once that breaks down, we look for a return back to that consolidation. That's point 1. It may not be a point 1 return back to the consolidation. It may go lower and then come back and trade into another PD array. Okay, it may create a fair value gap that it trades up into on the swing away from that original consolidation. Then we have an expectation that it's going to trade off and go lower. Same scenario here. We're looking for a measure of redistribution. On the right side of the curve, in price action model number 6, we knew that we're looking for fair value gaps and sell stops to form sell stops and fair value gaps. But that's going to be looking through the curve, which is the midpoint of this overall decline, to create a buying opportunity. For a price action model standpoint, again, focusing on the short side only, because this model is for short sellers only, or if the condition is we're bearish, this is how you operate in that model or that market profile. We look for areas of distribution in here. So we seek the liquidity trading down, going lower, and once we get to this price point, we have majority, if not all of our positions covered. Because we don't know if it's going to create this bounce, and we don't know if it's going to just consolidate and go sideways, or it can continuously go lower. Either case, taking profits here is logical, and it's something that you should be doing. So inside this shaded area, this is our range of opportunity. Accumulation, 0.1 redistribution, 0.2 redistribution, down to a sell side liquidity pool for offset distribution. Offsetting what? The short positions that were accumulated here. And reaccumulating long positions for a intermediate term or long-term continuation to the upside. All right, so with all that, we're going to go back to our example that we're referring to for price action model number 6 that took a great deal of time. Okay, as convenient as it was to keep you guys waiting, the profile shown on the dollar Swiss is what we were following. If you remember back on Twitter, I tweeted in here, watch these equal lows in here. Everything was framed on what I'm about to teach you and show you in price action for dollar Swiss. But we had equal highs in here, and we also had equal highs in here. So there's a draw on liquidity from a long-term perspective here, intermediate-term perspective here, and a short-term perspective here. And now I'm going to go into the actual price chart and break all this down using what has been shown here to give you greater insights and understanding. All right, so we're looking at the dollar Swiss. This is a weekly chart, and I'm going to get right into it. So you'll probably have to watch this video again multiple times to get the benefit of everything I've jammed into it. But right away we have several things that should jump off the chart at you. Now obviously I have the benefit of hindsight working for me here, but you also have to refer back to my Twitter and from any other previous commentary that I mentioned about this pair. We have equal highs in here. This is a weekly chart. So it's been several weeks since we moved from this low here. On the weekly chart, there is 2 market maker models. The weekly market maker buy model and continuation is seen here. We have consolidation, drop down to a level of sell side liquidity, then a rally up and continuation on the upside. We have a market maker sell model, which is the consolidation seen here. And I'll map this out for you real quick. So we have a consolidation in here. Usually I do this in green, but I'm just going to do it as just a real quick shading. And then we have our other consolidation up here. Okay, and above this consolidation we have that liquidity pool in the form of buy stops. And here's our consolidation here. It leaves consolidation, comes back. This is our reaccumulation, rallies on up, runs out the buy stops above this high here, creates equal highs, and then we enter a measure of distribution, in other words, selling. We're going to see a sell-off, but it trades back down to what? This specific candle right here. So I'm going to take this box off. I just wanted to show you the 2 price points that create the consolidation and the framework for what I'm going to show you. So we have our order block here. and that's just going to have to do for now. The open on this is 95.47, so keep that number in mind. So 95.47, when market was trading softer here, all during this period here, we're expecting the dollar to be bearish. Go back and look at our commentary. Okay, so all of this, all the way down into October, we expected weakness on the dollar. The pair's name starts with the dollar. So if we're bearish dollar, stands to reason that this pair should drop down, okay, in sympathy with the weaker dollar. Then we entered a period of time where seasonally the dollar index should be bullish. That actually occurred at the time period. Well, if you look at the low here, we have September 16th, and then in this candle right here, it rallied off at the last week of September. Okay, but it reacted off the order block. So it's a little ahead of the seasonal tendency, but it is what it is. The seasonal tendency for the dollar index being bullish, it transitions from September and October. Go look at your seasonal tendencies that were shown in the mentorship. So we have market maker sell profile here. And in the sell-off goes right back down into an area of what? Reaccumulation. So when we know these price points, as I talked about, price action model number 6 and 7, these points are going to be sensitive. Okay, and if we see it come back to that level here, we have to assume there's going to be some measure of bounce likely. Now that bounce, the storyline now has, it can bounce. Where is it going to bounce up to? Well, it can close in this inefficiency on the sell side and or run these equal highs. Bullish scenario for seasonal tendency for the dollar index. We trade down to a bullish order block. And we look at all of the highs up here. They're still clean. Okay, so we have all that going for us in terms of framework. So the bullish order block at 95.47 can be calibrated to 95.50 or 95.40. So we're going to elect to go with, since the open is what? We have a open of 95.47, so we can do 95.45 or we can do 95.40. So we're going to do 95.40, calibrating to a 0 level, and we'll go down into a daily chart and provide more insights. All right, and that's that. So now what we're going to do, we're going to drop into a daily chart. So we have our draws on liquidity. We can go down to the order block here when it's dropping down. And we have the buy side liquidity pool in the form of buy stops above these equal highs. And we've given the context of the fractals that's available at the time. Eventually, you'll see it when it's here. It could trade down from there and hit the order block. That's our discount array here. At a time when bullishness is expected coming into the dollar index. So we expect it to run up and hit these equal highs. Now, if we're trading down here and we expect it to go up to here, is that a day trade? Is it a scalp? Is it a short term, one shot, one kill? Sure, absolutely. And longer term, we have these over here. So we could do a lot of different forms of trading. But universally speaking, it's applicable to all of them, focusing on the buy side only once we get to here. Okay, so not focusing on shorting during this period here and up until these equal highs are taken out just makes the probabilities higher. Now, it doesn't mean you can't find shorts. Obviously, you can scalp and do one day trade, here and there going short. But it goes against institutional order flow, which is why I always say, why are you doing that? Okay, there's a lot of people. I know Chris Laurie, he promotes the idea of not having a bias, and he propels this theory in his groups that it's you have to convince me of this and you have to convince me of that. And with all due respect, I don't really have to convince anyone. I just know that this is what usually takes place. And the volatility and the expansion and magnitude is going to go in the direction of institutional order flow. So if I'm trading against institutional order flow, my expectations are going to be rather limited in terms of Contrarily speaking, if we were trading with institutional order flow, we know that there should be speed, there should be magnitude, there should be a great deal of volatility in that direction working for us, not against us. Okay, it's like that salmon analogy I gave in the free tutorials almost 8 years ago. A salmon's a strong swimmer. It can swim upstream, but when it gets to the top of the stream, it's dead. It does its business when it gets up there, but it's dead. I don't want to swim against the current. So in my teachings, I want you all to have that same mindset. You don't want to be trading against the grain or trading against the overall tide of the delivery of price. If the price is predisposed to go higher, why on earth would you want to go short? The probabilities are higher, stacked in your favor when you're trading, with institutional order flow. So with that said, we're going to drop down into a daily. Okay, we'll zoom out a little bit here and get a little bit more context. So we have our weekly order block here from our weekly standpoint using price action model number 7's conceptual theory. With this in mind, is price reaching down into this level here? This is our order block. Okay, so we're looking for 95.40. We need to justify and convince ourselves further with the narrative that it's going to go down to this level, but let's refine it a little bit more better than just that. If we go into this area right in here, notice that we had relative equal highs. Okay, we had relative equal highs here, and price did run above it, didn't reject and go lower. Okay, it continued higher. When I see that, what I'm looking for is a rejection block. Okay, so if this is a base of overall order flow where we saw resistance, and then it found support, and then it found support again. Okay, they have clearly outlined 95.45 as a specific price point. We see that in the form of that weekly order block. So it further sells the narrative to us as an analyst that this is very influential in terms of price action. So if that's the case, and we do at a later time trade down to it, I want to be focusing on the rejection block because that's going to be the discounted rate that's going to be important to me. We do have wicks in here, okay, but in here, we're going to look at this candle, and the lowest close is 95.42, okay? This down close candle, that's what we're looking for rejection block. The down close candle, the closing price is 95.42. 95.42, and we're up here. Okay, we're up in this area here. We expect the price to trade down to the rejection block. The expectation is it should trade to it and through it, but we only needed to trade to it. That's the rejection block. So price should come down into that price level, and we're going to calibrate it from 95.40 to 95.42, just so we have our rejection block on the chart. Okay, and we have these equal lows that it could be reaching for liquidity. We have a fair value gap in here as well. We have another equal low liquidity pool resting there as well. So all those are probable scenarios, but I'm looking for the low-hanging fruit, folks. Low-hanging fruit is this rejection block. Now, one could argue and say, well, the low-hanging fruit is right below here in the form of a sell-stop liquidity pool. I would agree to some degree, but we're close in terms of proximity with these equal lows. If it's going to go here, it's probably going to go to the rejection block and maybe even go for the fair value gap. So I elect to use the fair value gap. And that's what I had in mind when I was giving you guys the jawboning on Twitter about it. All right, so price breaks down. We have a consolidation in here. Let me zoom out now. We've done our business with that. All right, so we have our, I'm going to draw a trend line here, segment just to delineate the range. So here's our trading range here and our liquidity pool resting up here in the form of buy stops. I'll take that off just for completeness and clarity. So here's our consolidation. The market trades away from equilibrium, the high and the low seen here, sells off, comes back with this right in here. What is that? That is our first level of redistribution. So there was distribution here, There's distribution back here, obviously, but this is where the market leaves the consolidation, comes back. This is point 1 of redistribution. So it's our first selling opportunity. Trade down to this level. This is where we're looking for that rejection block. So that's our objective. It just so happens to be that's actually the low here, 95.42. Interesting enough. So right away, we can start looking for our grading of price swings. So we have this high back here. That's the top of our range. And we're going to draw it all the way down to the rejection block. Okay, for range purposes. So we have, in this essence, we have this price swing in close proximity. We have a level in here where we saw selling. In here, we opened, traded back up to it in the form of a Judas swing. Again, these are daily candles. And in here, we had a measure of distribution in here as well. So real nice distribution to get to that level. Taking it to the point at which it leaves the consolidation, which is this level here to here. Again, grading the price swings. We have price getting close proximity to this level. We have it here with this one. And there's a lot of consolidation in here. So we don't really get that, and much like I taught in the mentorship, when we get to the third grade of the price swing, before we get to the objective or terminus, the origin is here. Level 1, level 2, level 3 many times will not create an opportunity because it's just going to be in a hurry to get down to terminus. All right, so we have that. Point 1, distribution. Point 2, redistribution. In here, it comes really deep in here and then sells off again. I gave multiple scenarios on how we could look at these price swings in here on a 4-hour and a 1-hour basis. Each one of these was a market maker sell model. Consolidation, rally up, distribution, sells off, makes a lower low. Consolidation, rallies up, runs higher, bodies, not wicks. Okay, distribution, lower low. Okay, here's another one. Consolidation, rally up, distribution, lower low into terminus. Okay, and I'll show you what that looks like when we get into lower time frames, and we'll do that now. We're focusing on, this is our range of opportunity. Again, using the price action model number 7 criteria. This is all we're looking for. That's the range. Okay, how are we going to operate in that? Up close candle into the consolidation. That is our initial distribution cycle, where we're going to see the first measure of, or expect to see rather, selling off. If we continuously rally up, then that completely negates this whole profile, and we have to put it on the back burner and we wait. If we took a trade, we took a loss. It's simple as that. But if we see a sell off, then we know that we can go back in and look for levels of liquidity to sell at. And what does that mean? Well, keep going on over here. Keep looking over here. What do you have right there? What is this? From this candle's high at 97.24 and this candle's low, 97.47. Okay, watch. We had sell side offered right there. And the buy side imbalance starts right there. So right between these two price points, there's only buy side offered. We're expecting price to go lower. We see the sell side delivered here. So once this closes this point right there, this range from high and low, delineated by 97.47 and 97.23, that becomes a balanced price range. What does that mean? That means that it should act like a natural support or resistance because the balance of buy side and sell side has been offered. Notice that it's happening when we're expecting it to trade down to here, lower prices during a seasonal tendency for the dollar to be weaker, and we have our PD arrays outlined. Look at the bodies of the candles. Yes, it wicks through here, a little bit by here, and a little bit in here, but look at the bulk of the volume delineated by the bodies of the candles. Heavy distribution in here, heavy distribution in here, and then trades down to terminus. Okay, we're going to have this insight on our 4-hour chart. We'll drop down into a 4-hour now. Okay, so now we have our price range defined here. We're going to look at this range from the first level of redistribution down to terminus, because terminus is already predetermined. That's not after the fact. It's a determined price level before it even trades there. Okay, so you can see the delivery of price right after it trades into that balanced price range. Cut left. You see this up close candle? They bought in here. Whatever they bought in here, it has to be mitigated. That's a mitigation block right there. Why? It's trading back up into it after trading into a balanced price range in a seasonal tendency in an existing price model, the market maker buy model. You have consolidation. We're trading down. How far is it going to trade down, Michael? I'm showing you. Everything that's shown here is conceptually shown in the mentorship and what I've shown you in the theory portion of model number 7. In other words, the first half of this video. The distribution cycle that occurs in here and in here, inside these two price ranges, that's a balanced price range. This is a 4-hour chart. What do you see? Before I do any further revelation to you, what do you see in the chart? Optimal trade entry. Optimal trade entry. We have equal lows. Price is going to want to distribute and go lower. Every time we create a new low, we do 10, 20, 30 pip grades below it to get our targets on how far our price is going to reach till we get to terminus. Okay, so let's go back into price through an hourly chart. Okay, there's our balanced price range. Price breaks down, rallies back up, sells off. Rallies back up, hits that balanced price range again, sells off. What's it targeting? The liquidity below the low here. So now we have a liquidity pool resting below here. Even though we have this deep rally up, what's actually happening? We have a market maker buy model. We have consolidation. Okay, this whole consolidation, this low to the high, that's the range. Okay, price trades back up into it here. That's your return for consolidation. Distribution should kick in. It does. Okay, then it rallies back up into this level in here. It's an up close candle. Redistribution. Sells off. What's it targeting? The lows. Okay, so the market's going to seek liquidity below for a low resistance liquidity run. Price has a rally all the way up. This is not in our model. Maybe we took something in here as a sell. Maybe got wiped out, got stopped. No problem. It returns back to the balanced price range. Price breaks down again. So what do we see here? We have consolidation, reaccumulation, reaccumulation 3 times. See that? So this is the highest one. When price breaks down below that, there's our market structure shift. Price rallies up. This is our low risk entry. Sells off. Right in here. This is this next sell. Why? Because it's focused on this side of the curve. It reversed here. So go left. All down close candles is what we're focusing on in swing lows. There's our price point to match up our liquidity. So it's right over here. Smaller short-term optimal trade entry if you go into a 15-minute time frame. Sells off into what? Bullish candle prior to a down move. What is this? Bearish order block. Optimal trade entry at the point of our liquidity distribution profile. Think about what I showed you. This is where they should sell off because they bought long here and they want to mitigate here. Then we'll have a what? A low resistance liquidity run to attack the sell stops below this low. It runs aggressively for it. Okay. We have a market maker buy model, consolidation, trades down, distribution, sell off, rally, distribution, sell off. What's it reach for? Liquidity below here. Now we consolidate. It rallies again. It goes above, comes back down, retraces into what? This up close candle was where they sold before. They got to mitigate it right here. Rally up again to what? To run above these sell stops. All of this is price action model number 6. But dovetailing with price action model number 7. Because now we have an imbalance in here, sell side delivery, trades back up to that. There's our discount and premium arrays working together. Now this is a premium array. It sells off. What's it going to attack? The liquidity resting below here. Selling short. Optimal trade entry, if you want to look for just a pattern like that. Okay, we have fair value gap here. Runs lower. Ultimately, trying to reach for that 95.42 rejection block or lower. So price makes a run below this low here and then creates what? Consolidation, rally, return to consolidation, rally again. What's it run out? The previous high. So now we can look for what? Distribution cycles. Market breaks down. This is the only one we have for a shift in market structure to break. It doesn't happen until here. So what does that mean? The next one is the consolidation. So if it's this one, if we get a sell-off in here, it's going to be much more pronounced, not just a shallow run below the lows. And look what it does. Runs all the way down to terminus. Okay? So there's a lot of dovetailing of all the things that you learn in mentorship that's being shown here. But on the sell side of an existing bullish scenario, all of this shown inside of this portion of price action. This is the usable part of the fractal, using the concepts and the liquidity distribution profile that I showed you in model number 6 and model number 7 here. If I go back out to a daily chart, okay, and we zoom in on this short-term low here. The low comes in at 95.78. Essentially is basically 95.75. Okay, so 95.75, because if we're up here and we're trading down to this low, if we're expecting that low to be taken out, it's reasonable to expect 95.75 will be traded to, right? Because we're looking for 5 levels and 0 levels. So if we're calibrating to 95.75, 10 pips below that would be 95.65. Then 20 pips would be 95.55. And then 30 pips would be what? 95.45. So even if we don't use a rejection block and we calibrate to, again, low-hanging fruit, looking for the easy objectives and targets and only working with that, not trying to be Mr. Precise, don't try to be an ICT clone. Below this low, we have a 30 pip grade swing potential to 95.45. And again, it only went 3 pips below that to 95.42. But we already had 95.40 calibrated from a weekly order block. Once this is arrived at, once we understand that, we have a context to work within using the narrative that the price is providing us. Now, obviously, watching this, it feels like an oversimplification. And believe me, I appreciate that, and I know the gravity of what I'm saying. It seems like it's, an oversimplification, but I'm also taking into account that you have gone through all of the core content and you've watched me use these things, and I'm telling you how I do it. Everything that I teach in the mentorship is being applied here. The imbalance that's shown right in here. Okay, right in here. I'm going to show you that one as well. Zoom in. We have this candle's high. Right there at 97.62. Remember, everything has to rebalance. That's the whole point of what the markets are doing all the time. It's not anything other than that. It's all liquidity based. So on a daily chart, this candle's low here is 97.68. Okay, so we're only talking about 6 pips in separation. And we'll leave this one here as the overall balance. So a rebalancing on the buy side here, we have a fair value gap here, and we have a fair value gap that was outlined from this low right here. We'll just leave it as it is and look at the delivery of price. The high is exactly 97.67, 1 pip away from our predetermined fair value gap. Again, over here, what are we using? You got to cut through all this and determine where the imbalance is. That's what the algorithm does. That's all IPTA's function is to rebalance and or engineer. It's simple. It's simple as that. Now, what makes it hard is determining what is going on at the time in the market and fitting a narrative to what you see in price and the possible scenarios that could unfold relative to a bias. And what's the bias? Based on a weekly chart, because that's where the large funds are building their bias and using a daily chart for entry. And that's the whole thing in a nutshell. Once we understand that and we take a step back, then we can see, oh, wow, look at this. We entered a period of September, October bullishness for the dollar. It hit a weekly bullish order block. It completed a market maker buy model. And now we have these equal highs up here. So we should see what price should reach up. And it does. It hits it. The market maker buy model completes right here with this. And then, not surprisingly, we see the market sell off. So hopefully you've learned something from model number 6 and model number 7. That really is like the core underpinnings to what I do on my weekly analysis. I mean, I don't really do anything more than just what I just taught thus now. If I stop and don't do any more price action models, and I never teach any more, everything that I use in my weekly analysis. That's it. I don't teach anything beyond that because it's easy for me to operate on a week-by-week basis using what I just taught. So everything from today's video, going backwards, everything I've ever taught, now everything I use to make my weekly analysis commentary. And you've seen how consistent it is. And if that's all you aim for, or just 3/4 of that, okay, you're going to do very, very, very well. You don't need a whole lot to do very well in this business. But you do need a model and you need to have a context to work within. And I've provided that with you now. So next time, I wish you good luck and good trading.